Hey, Dr. Asatar Bear, and this video is about supply and demand, equilibrium, the process of reaching equilibrium in the market. Right? So, market equilibrium and the adjustment of markets to new equilibrium. Okay, so let's start with what we know. Right? So, in terms of supply and demand, right, we have let's draw a graph, the price, and we have the quantity supplied and the quantity demanded. I'm drawing those separately because we have different relationships for each, right? The quantity supplied gives us the supply curve, and looking at the quantity demanded relative to the price, that gives us the demand curve. All right, so what we want to do is look at how do markets adjust to changes in price. How do markets find an equilibrium price? All right, so we notice that there's only one place on this graph where the quantity supplied and the quantity demanded are the same, right? So here, the quantity supplied and the quantity demanded are the same, right? If we chose a different price, like let's say we chose a price up here, well, here, the quantity supplied is a lot higher than the quantity demanded. Okay, let's just put some numbers on this, just for the hell of it, right? Let's say that the price at which these two are equal is $10. Okay, and let's say that this is the t-shirt market. And the this price up here is, let's say this is $19, right? So $19 versus $10, well, those are just different prices, right? Could we say that one is right and one is wrong? I mean, prices are just different, right? Well, according to the theory of supply and demand, we are saying that one is right and one is wrong, right? What is wrong with this price of $19? What's wrong with it is that the quantity supplied far exceeds the quantity demanded. Well, let's put some numbers in here just so we can see. Okay, let's say that the quantity supplied is 100,000 and the quantity demanded 25,000, right? So at a price of $19, quantity supplied 100,000 is far greater than the quantity demanded 25,000. All right. Now, this situation is not good for society, right? Why? Well, because resources, land, labor, capital, etc., went into producing 100,000 t-shirts, but society, that is buyers, right, only want 25,000 of them at that price. That's a waste. That's not good. That's a misuse of society's resources, a misallocation of resources. Okay, that's a problem. Okay, the problem, we could call it excess supply, or it's often known simply as a surplus. There's too many t-shirts out there, and we can even see how much there is, right? The excess supply is equal to 100,000 minus 25,000. My God, there are 75,000 excess t-shirts. There's too many t-shirts. What a problem. What do we do, right? Well, here's where we get into the process of equilibrium. If we assume that this market is perfectly competitive, okay, we assume that perfect competition exists in this market. There's a bunch of stipulations for this, that there's many buyers and many sellers, that no one can exclude anyone from the market, that everyone has information about prices and so forth, okay? But just think about it, many buyers and sellers, that's good enough for our purposes for now, right? There's 75,000 extra shirts. What stops this problem from happening? Well, they don't all sell, right? And the t-shirts go on sale. As they go on sale, we move along the supply curve. It sends a signal to suppliers, produce fewer of these, right? The law of supply. And it sends a signal to buyers, well, buy more of these, right? Or you can now get a t-shirt for $17 instead of $19. Well, maybe you'll buy one at that price. You weren't going to buy it if it was 19, but at 17, okay. At 15, well, you're even more likely to buy it until we get to the price of $10, at which point there is no more excess supply, right? So excess supply tends to cause the price to fall, right? What we're talking about is a market adjustment process. If the price is wrong, now wrong, is there some kind of natural law that says t-shirts should be $10? No. It's not based on the number, it's based on the quantities, right? If $19 was the price at which the quantity supplied and quantity demanded were the same, then it would be $19, right? There's nothing wrong with $19 per se. It's just that in this particular market at this particular time, $19 is wrong, right? It is the wrong price. It's at that price the quantity supplied exceeds the quantity demanded. But the market adjusts by itself to fix this problem, right? The market adjusts by itself. What if we had the opposite problem? What if we had a price that was too low? Okay, $5. At $5, well, now we have pretty much the opposite situation, right? We have a situation where the quantity demanded is far greater than the quantity supplied. Okay, so at price equal to $5, quantity supplied far less than the quantity demanded. Okay, so we have a different sort of problem. It is the problem of excess demand, also known as a shortage. All right, so here we have now people are running out of t-shirts, stores are running out of t-shirts, and you go in and, oh, I've got $5, I want to buy a t-shirt, but there's no t-shirts on the shelves. The price is going to rise in this situation. We're saying that the stores, the suppliers, are going to be aware that they're selling out, and they will raise the price, right? Because they have a profit motive. They always want to raise the price. What stops them from doing so is that they don't have the demand. There aren't enough buyers at a higher price. But now they see, okay, there are. We can now raise the price. Again, the market adjusts by itself. Okay, we get from this the idea that markets are self-regulating. They regulate themselves. They rule themselves. Okay, so that we end up at this equilibrium price, $10. It's such a special price that we're going to call it P star, right? And the quantity at which that happens, we'll call that Q star. Okay. Let's say that that's, I don't know, 50,000, right? So price of $10, quantity supplied 50,000, quantity demanded also 50,000. There is at this point no tendency for the price to change. Because what would make it change? Well, either excess supply or excess demand, and neither of those things exist. Right? The price is exactly right. The price, P star, the price is right. All right. Now we could say more about this, okay? Because we can say, look, P star, if this prevails, this is very good for society. Very good for society. We make several different points here, okay? The first is that P star is a fair price, okay? It's a fair price. So P star is equal to the true value of the commodity. We call that W, right? That is, the price, what it actually costs you to buy it, is equal to what it is worth, what it should cost, right? It's fair. There is no rip-off to either the buyer or the seller, right? No rip-off. So that's fantastic, right? Of course, the buyer would always like a lower price. The seller would always like a higher price. But that's life, right? To be fair to both sides have the diametrically opposed interests. So to be fair to both sides, we have to meet in the middle, right? Uh, this price is also stable. Okay, so P star has, again, no tendency to change, right? The quantity supplied is equal to the quantity demanded. Okay, so this notion of a stable equilibrium, okay, this is what we're calling it, okay? Microeconomic theory calls this equilibrium, okay? It's a stable equilibrium as opposed to an unstable equilibrium, okay? So equilibrium just means that we are at a position that's at rest. Again, there is no tendency for change. All right, so when we say a stable equilibrium, we mean something like this, right? If this is a bowl, and here's a marble, right? The marble is at equilibrium at the bottom of this bowl, right? If we were to put it somewhere else, it's going to roll down until it's at equilibrium, right? Maybe it'll roll around back and forth a little bit, but eventually it will come to rest. That's what we mean by a stable equilibrium, okay? If it's disturbed, it returns to its point. This is our metaphor for self-regulating markets. Okay, an unstable equilibrium would be like this, right? A marble could theoretically be at rest like this, right, on top of like a hill or something, right? It's just that if it gets disturbed, there's nothing that brings it back, right? If it gets disturbed, it's going to fall off of this. It won't return to this point, right? So the difference between a stable equilibrium and an unstable equilibrium is, are there forces which bring it back to the equilibrium? We're saying here that there are, right? It is at rest, and the forces of the market return to equilibrium if there's been some disturbance. Okay, so more on that shortly. All right, so fair, stable, and the final point here is that this equilibrium is efficient. All right, so efficient means that we're able to get the maximum output given society's resources. All right, society has a certain amount of land, labor, and capital. What can we produce with those things? Well, we have a certain amount of knowledge, we have certain technology. That is our how do we produce given our resources. But given all of that, right, there is a certain amount of output that we can produce, right? And we are going to produce that output by producing the quantity that is equal to that which people want to buy, right? And what makes that happen? Well, competitive markets make that happen, right? Competitive markets provide the incentive to adjust the price so that the price is correct, right? That's what we're calling P star. And also to produce efficiently, okay? So produce at the lowest cost. Right now, it takes much more time to develop this argument for why perfectly competitive markets are efficient, but you can kind of see, just even within the supply and demand graph itself, we have this argument is embedded within that, right? The price at which the quantity supplied equals the quantity demanded, okay? Again, that is very good for society for these reasons, okay? So the next topic is, what happens if there's some change to the equilibrium? How do markets adjust to that change? All right, let's look at that next. So markets adjust, market adjustment. All right, let's take an example. Let's say, here's the price, here's the quantity. Let's say that this happens. Okay, we are initially at our supply curve looks like this. Over time, it changes, it increases, shifts to the right. And here's our demand curve. Okay, let's say that there's been no change in the demand. All right, so in this market, let's say that our initial equilibrium, okay, before the change, the supply curve was at S1. Let's say that the price was, I don't know, let's say the price was $500, right? And the quantity was 200,000. Okay, so $500, 200,000. But something happened, right? Suppliers changed, their willingness to supply changed. Okay, let's say that this happened. Okay, we had an increase in technology that lowered the unit cost, meaning suppliers are willing to produce more than they were before. Okay, so at $500, suppliers are willing to supply far more. Okay, let's say 220,000. I know my scale here isn't very good, but you get the idea. All right. So at point A, right, we were at equilibrium, right? The old supply curve, the quantity supplied initially was equal to the quantity demanded. After the change, suppliers start producing a lot more, and we're now at point B. All right. But look at this. At point B, there is now an excess supply. Because at $500, the market was capable of absorbing 200,000. That's the quantity demanded, right? Is it capable of absorbing 220,000? No. See why not? That's not on the demand curve, right? Unless the demand curve was to also shift, but it hasn't, right? We've said there's one shift has occurred here. Okay, that's the shift in supply. So there's excess supply. The market will not absorb that. Okay, the quantity supplied at this price, 220,000, is far greater than the quantity demanded, 200,000. Okay, what is going to happen? Well, the price is going to fall. Okay, this is the market adjusting to a new equilibrium. Okay, so let's say that the new equilibrium price is 350. Okay, so here we are, point C. So the market adjusts to this in exactly the same fashion that we said before, right? That is, excess supply pushes the price down up until the point where the quantity supplied equals the quantity demanded, okay? So price falls, quantity increases. That is, we move along the demand curve. Okay, so a shift in one curve, right, the supply curve has shifted, causes a movement along the other curve. Okay, now most of the time in on an exam situation, we just do one thing at a time, right? One shift and only one shift. That might not be all that realistic, but it helps us to have like a clear answer. Okay, so the shift in supply causes a movement along the demand curve. There is excess supply, which pushes the price down, right? Do the suppliers want the price to fall? No, but they're not in charge of this, right? They would love the price to stay high, but they're not in charge of this, right? They have competition. Competition is what forces the price down, right? If they didn't have that, then it's maybe there'd be a different result here. But the long and short of it is you can't make people buy, right? So if there's excess supply, you're going to have to reduce the price in order to get people to buy it, right? They're only the people are only willing to buy up to 200,000 at a price of 500. Okay, then we get to a new equilibrium price. A new P star is reached equal to 350. All right. Let's say that this is the market for TVs, let's say, right? Because this is true for almost every manufactured good that we can think of, right? Pretty much every manufactured good has seen some kind of pattern like this, right? Like increase in technology pushes the supply curve to the right, which pushes down the price. All right. So Now, the price might not fall over time as much as we might like because there's also demand changes that happen. But again, we're trying to just isolate and say only one thing that happens at a time. All right. Now, neoclassical economics and Keynesian economics begin to part ways on this issue, right? Because the neoclassical economics assumes that markets adjust to the new equilibrium very quickly, right? And so their assumption, we can see this in the assumption, which is that we're always at equilibrium, right? The adjustment period in between period is negligible, right? And nothing needs to happen, right? Markets are self-regulating. No outside authority needs to come in and say, oh, lower the price now, right? Markets do that on their own, right? Markets are self-regulating. Okay. The Keynesian theorists argue, well, that may be true for some markets, but there's lots of markets, many markets, don't adjust well. They don't adjust well. They're maladjusted. They're, the price doesn't fall quickly. It takes a long time to fall, or maybe it doesn't fall at all. Maybe the market gets stuck. The price cannot rise or cannot fall. Okay, this is called market failure. And Keynes emphasized this a lot more, right? He said, look, we can't assume that markets are self-regulating because there are many markets which fail to adjust to price changes. All right. Let's do another example. Let's say it's not the supply that shifts, but the demand. All right, so price, quantity. Here's our initial demand curve, and we have a new demand curve, D1 to D2. Here's our supply curve. Okay, so what the process of adjustment here, we initially would start at point A. Okay, we have a certain price and quantity, and then we're going to shift to our new equilibrium at point B, moving along the supply curve. Okay, so the demand increases. Again, think about this in terms of the shift. It shifts to the right, and now the market is going to adjust to this, right? We have an initial price equilibrium. I wrote P star 1, Q star 1. We're going to adjust to our new equilibrium, P star 2, and our new price and quantity equilibrium. Okay, so, and the way that this is going to happen is similar, right? That is, in the short term, what occurs here is, and remember, we start at point A. So after demand shifts, well, before the market has gotten wind of that, how does the market know that demand has shifted? Well, the way the market knows is the old quantity that was demanded at that price. Let's say that the old price is $5, the old quantity 25,000. Well, now there's a much greater quantity that's demanded at that price. Okay, let's say now there's 50,000 that's demanded. So the quantity supplied is still 25,000. The quantity demanded is now 50,000. So because the quantity supplied is less than the quantity demanded, we're going to have a shortage. We're going to have excess supply. And that shortage is going to then push up the price. Right? That is the mechanism. Okay? Prices rise because of the excess demand, right? That because of the shortage, which then causes a movement along the supply curve. Okay, so the shift in demand cause a movement along the supply curve until there is no further shortage, right? At the higher price, people are less willing to buy, right? We have moved along this demand curve. and we have moved along the supply curve, there's more produced, okay, until we get to the new P star, right, P star 2, at which point the quantity supplied is equal to the new level of quantity demanded, right? And then there's no further pressure on the price. There's no further reason for the price to change. All right, so again, market failure would occur here. Market failure means the price fails to rise, okay? So market failure in this example, price, in general, it means the price fails to adjust to a shift in supply or demand or both, right? Whatever it is, whatever the shift that's occurred, the market does not adjust the price to it. That's a market failure. So if the price did not go up, that adjustment would not take place. Okay. So we can see this kind of market failure occurring. All right. So if we look at price controls, right? So this is where the government sets a price by law, right? They make the price higher or lower than it would otherwise be, and that's mandatory, right? That's part of the law. So price control. Here's our supply curve. Here's our demand curve. And let's say that in this market, the equilibrium price was, let's say that, let's take the market for toilet paper. You guys might be able to imagine a situation where there's unusually high level of demand for this stuff. Let's say that ordinarily the price is like $5, right? And the quantity, let's say 200,000. Okay, price quantity. So this is the P star and Q star. All right. P star $5, Q star 200,000. All right. So let's imagine that the government sets a policy by law, right? They say, all right, look, we are not going to allow the price to be below a certain level, right? So this would be a price floor, okay? A little bit counterintuitive because we think of floor as being below something, and this one is above the equilibrium, but think about it this way. The price would like to fall, but it gets stopped by the floor, all right? Or let's say that the government does a price ceiling. Right, price ceiling, price floor. Okay, again, this means by law, a price floor would say something like this, right? It's now illegal to sell the toilet paper below below a price of, I don't know, let's say $10. All right, it's illegal. So the problem that this creates then is, well, we have the market cannot adjust to this, right? It's going to have excess supply, and that is that's a problem. The case for efficiency said P star is good for society, right? It's fair, it's stable, and it's efficient. Well, we've taken away some of that now, right? Because if we set the price at a different level, well, we can't really say it's fair anymore, right? I mean, we've made the price higher for the sellers, to favor the sellers, and we can no longer say that it's efficient because the market is now producing too much of it, right? The problem is the excess supply, and that excess supply must be destroyed. We can't allow it to enter the market, otherwise it'll bring down the price, right? We're trying to control the price at a higher level, okay? If we had a price ceiling, that would be illegal to sell our toilet paper below a certain price. So let's say $2, right? It's illegal. I'm sorry. It's illegal to sell above a price of $2. Again, the price would like to rise, but it gets stopped by the law. Right? Now, price ceilings are pretty rare in the United States. Okay, because they're done for the buyers, right? The buyers are normally a lot more disorganized than the sellers. There's far more buyers. It's much more challenging to get them together, right? When the government sets a price by law, they are favoring either the buyers or the sellers. They are favoring one side of the market, right? And they are allowing a ripoff to occur, right? They are facilitating that ripoff. Okay? It's rare for the buyers to get this kind of treatment, okay? So we have to go to another country in order to see this kind of thing, okay? We have to go to, say, the USSR, that is the Soviet Union, in which there were some price ceilings for things, and those things predictably then had shortages, right? This is not all that happened in the Soviet Union. There were plenty of markets which were totally functional, but they did have some price ceilings, and the price is set at too low a level, there's going to be a shortage. All right, so in terms of price floors, these are actually very common in the United States, especially in agriculture. A lot of price floors in agriculture. The other term for this is a price support. Okay, so they're not always called price floors, sometimes it's called a price support, but very, very common in agriculture. You have this thing in the United States called the Farm Bill, and the Farm Bill is basically many hundreds of pages all about price supports or price floors for large agricultural corporations. All right, so we can see the argument for markets are self-regulating, right? That is the bottom line of this whole discussion, okay? Markets are self-regulating. If we try to regulate them, we shouldn't do that, okay? We don't need government regulation of prices as long as the market is competitive. If not competitive, then markets are not going to do a good job of regulating themselves. But as long as we have competitive markets, we don't need government regulation of prices. All right, that's my lecture for this section. Thank you very much.